Welcome to TheoTrade. This is Don Kaufman. Here we are doing the weekend edition. It is March 27th, 2016. Do you know where the markets are? Let's do a quick kind of update on some of the action that we saw last week, albeit some fairly light action last week. And more importantly, let's look ahead at the coming week over here. We have some very interesting areas to take a look at. So first and foremost, I'm going to use the S&P futures. So I tend to look at the S&P futures again as kind of a litmus test for the entire marketplace. And again, regardless of what you might trade, not everybody is a futures trader. That's fine. Okay, that's absolutely fine. You're trading Google, you're trading, some Apple shares over there. But if you really want to see if the markets are kind of rocking, you got to look towards the E-mini S&P futures. Ultimately, because everybody else in the entire trading world, that's what they're looking at. It's because the world goes to the E-minis to manage their risk. Okay, fund managers, hedge fund managers, really, if you manage any amount of money over there, you have to use the futures, okay, to manage your risk, especially on a global scale. So reading not only into what the futures are doing is helpful, also the volume. And the one thing I'll note, the volume throughout last week, felt like a holiday week. Obviously, Friday, the markets were closed, right? We didn't substantiate much more than about 1.5 million contracts in the S&P futures, even though coming into Wednesday, and again, was a shortened week, so the last day of the week was Thursday, but I'll kind of zoom in here. Even on Wednesday when the S&Ps, they sold off a bit. This is nothing significant. There's no volume to it, so it was like a low volume rollover. I talked about that last week. On Thursday, which was the last trading day, we threatened to sell off, but, ended massively unchanged. I mean, literally the markets were unchanged on the trading day. Again, very, very light volume. Neither here nor there. Let's move forward because, again, recapping what happened in the past, hey, hindsight is always 20/20. I coulda, I shoulda, but you didn't. Everybody's always looking to the past. Got to look to the future. And what do we see in the future? Okay, first and foremost, what do we see out here? Well, we see a lot of earnings about to be coming. So we're going to enter into another earnings kind of period over here. It kicks off. Yes, how exciting. So as we get into April, right in the first 2 weeks of April, we're going to get a slew of earnings. People often look towards, certain securities like Alcoa as being the kickoff to earnings, and that's because Alcoa used to belong to the Dow. Nobody cares anymore about Alcoa. The stocks that really start to kick off the earnings period are actually going to be your financials. So when you really want to start looking for like earnings, that's when you look towards some of the financials over there. And you kind of, scroll down and, take a look like, what do you got in financials? One of the ones that always comes to mind, something along the lines of Goldman Sachs, or look at Bank of America, all right, or Citi, or JP Morgan. But all of these products, okay, are going to start to have their earnings announcements. Now, Goldman Sachs is a little bit further out in time, but rather than look over at the chart for the earnings date, start to get used to looking at implied volatilities. If you really want to decipher when is the earnings announcement going to be out, look no further than you just down the implied volatilities, like boop, it pops right out at you. Okay, the implied volatility is going to be obviously different, substantially higher in the earnings announcement. Now, maybe in the financials you don't see it as much as something like Facebook. Okay, why do I bring up Facebook? Because all of a sudden it sticks out like a sore thumb, right? 31% implied volatility. Then you bring it up an underlying like Citi. Okay, well, Citi all of a sudden 19 days out, and the 19-day expiration, boom, 35% implied volatility. Go over to a chart. Again, we're coming into the earnings announcements. The reason I start with this kind of look ahead at next week, the reason I start with discussion of earnings announcements is not so much that we at TheoTrade are inclined to trade earnings. Okay, whether you've heard this or not from me, it's not just been my experience, but tremendous amount of research supports what I'm about to state. When trading earnings, there isn't any definitive advantage to trading options or stock for that matter around earnings. Now, people find earnings very, very exciting, entertaining even, okay? But if you looked at earnings trades and looked, at thousands and thousands of occurrences, whether you buy options, whether you sell options around the earnings announcement, there really isn't, again, when I say any statistical advantage, there isn't any positive expected return. So we will trade a few earnings announcements, kind of do it a little bit, as part of an exercise, maybe even a little bit like tongue-in-cheek over there to trade some earnings announcements because, it's part of the action over there. However, be advised, there's no definitive edge for you trading an earnings announcement. Again, there is phenomenal amount of research to back up that statement over there. Everybody's got like the newest strategy around earnings. Hey, listen, you want to trade earnings on something like Citi? The last time I looked, what is there? You got calls and you got puts. You can buy them and sell them. That's it. Okay, there's no new combination thereof. But again, I caution around earnings. So what do you do when the earnings are coming up in all of these different products? You're like, well, I still need to trade. Of course you do. However, if you're a little bit nervous of the earnings announcement coming out, okay, can you trade coming into the earnings? Yes. However, if you trade options, okay, lots of us like to be sellers of options, okay, and I could use Facebook, or I could use Citi, or I could use Apple, and there's umpteen different underlyings. Google always comes to mind because Google is one of the major technology companies to kind of bring out their earnings first. It's in the 26-day expiration, so we're less than about, 20 less days, or 20 plus days to the earnings in Google. But a prime example is this. You wouldn't want to go out and sell option premium, okay, in the 26-day expiration, nor the 33-day expiration, because the decay is not going to come out of these options. Why is the decay not going to come out of the options? Because the implied volatility creeps higher and higher. It doesn't mean the option increases in price. Okay? What happens to options prior to the earnings is simply this. Normally, when options decay, they decay like this, right? So the option over here, for instance, is $20, then it's worth like 18. Then down here, it's, it's kind of linear. It's trading at like, 16. All of a sudden, you're like, boom, this thing hits the rock. You're like, $8. You're like, it's not even worth getting out. Now, that's how an option normally decays. But around an earnings announcement, and here's the 26-day expiration, it's more like this. Boom, right down. So it's a much more linear burn, and then it drops off heavily. So again, decay differs drastically around earnings. So then somebody says, well, can I buy options before earnings? You can buy an option, but there's still going to be decay around it. And if you're not right, you will still get hammered. Carrying a position through the earnings period, again, there's no definitive advantage per se in doing that. So with that, where do you go? If you don't want to trade Google, or for instance, I said, many of these stocks are going to have earnings coming up. Where do you go? This is a time when I actually like to run to ETFs. Okay, I trade more ETFs around earnings period than any other time. The other thing I like to do, I am a huge advocate of trading products just after their earnings announcement. They make a wild move to the upside. You're like, oh yeah, I'm going to sell into that. They make a wild move to the downside. You're like, ooh, it's going to get crushed, pile on. Earnings can be a phenomenal time. Number one, though, if you're trading stocks just after the earnings announcement, you got to be pretty careful. I mean, it's a volatile time. So if you want to circumnavigate earnings altogether, run to the ETFs. And you're like, but there's just... what? There's a ton of ETFs over there. I bring up the XLE. Now, I've had some positions on the XLE, and I've got a position right now on the XLE. Happen to have a bearish position on the XLE. And ladies and gentlemen, this thing, it's coming right to fruition. It's coming right into expiration. We're getting close. Okay? Last week I closed out trades in Amazon. I closed out trades in EEM. I rolled trades in the SPX. I'm a rolling, closing fool out there. We've had some good trades. Okay, we need a couple of things to come in this next week. But the XLE, prime example. It's a product you trade instead of trying to mess around with, for instance, something like ExxonMobil right before earnings. Circumnavigate a couple of the risks. Because what does the earnings do? Oh, the element of surprise. I know some of you might like that, Okay, but the element of surprise can also completely, as we say in trading, rip your face off. So I go to the Qs for technology. Okay, what else you got? Like retail. Now, retail brings up an interesting point. The XRT isn't all that liquid. Okay, the monthlies are plenty liquid. There's plenty of contract size over there. But the retailers, generally speaking, they are on a separate kind of cycle there for earnings. So if I go look at an individual retailer, and I pick Target in this case, it's actually passed through its earnings not too long ago. Now, Target, for me, is a target I look to get short. No pun intended. Please let that one go. Anyway, you look at the implied volatilities. They're all right around 20%. Target had a phenomenal move to the upside over here. If you haven't noticed yet, Don, that's me, likes to get short from time to time because those short opportunities, it takes 20 days for a stock like this to grind to the upside. And it'll take one big bad day in the market to suck it right back down. And that's the kind of trades I look for. And I think Target here is prime for a short position, so bear with me because I like to build positions. There's an 83, 81 put spread. It's $2 wide put spread. $2 wide put spread for a 90-cent debit. It is a bearish spread. Why do I buy it? What's worth selling at a 20% volatility? You're not going to sell anything out here. People look at option statistics. Great. The IV percentile. How low can it go? It's 16%. Go out there, risk 90 cents. Okay? That's it. You're risking 90 cents. Okay? You can make as much, and you should get out of this trade after you make about 55, maybe 60% of what the risk is. So if the risk was like $1, you're trying to make anywhere from 55 to 60 cents. In this case, the risk is 90 cents. What are we really trying to make? Okay? This isn't trying to hit it out of the ballpark. You're trying to make about 50 cents on this trade. That exact style of spread, okay, what I kind of call the risk a buck to make a buck, these are actually high probability trades. And you're like, how? It's exactly what I'm going to be explaining this next weekend. It's April 2nd. We're actually going to do a class called In-Out Spreads. And I'm going to show every detail of why I use, very often if I want to get directional, of why I use these risk a buck to make a buck kind of strategies. And if you are just the slightest bit curious about this, and serious, the class, okay, I have done classes for the last 15 years on trading this style. And these are the spreads that really make the huge difference in your ability to trade directionally. Everything I do, it's about strategy and trade logic first, right? You got to know logically that if you did thousands of this trade, that it's going to work time and time again. So very simply put, you go out and you purchase the 83-81 put spread for 90-cent debit. Look, it's in the 33-day expiration. And knowing what expiration, it's a huge portion of it. You could do the 5-day or the 12-day, the 19-day, the 26-day, the 33-day. Why did I key in specifically to the 33-day? Look at the probability of touching. Okay? Almost an 83% chance of touching 81 with only 90 cents at risk. Okay? These, I'm letting you hang here a little bit, but these are some of the key areas that I'm going to discuss in this class. It's In-Out Spreads. It's April 2nd. If you're a subscriber to TheoTrade, we do Total Theo. Check it out. For those of you that are subscribers, fantastic. We will see you in the class. It's bright and early, April 2nd. How early? Well, just note, you're going to be up, when I say bright and early, you're looking at 7 a.m. Pacific, 10 a.m. Eastern Standard Time. One other area I want to leave you with this coming week over here. There's a very unusual occurrence going on inside of the SPX. Okay, it's really worth looking at throughout the course of the week. It's the first time it's ever happened in the history of the marketplace out there. And what's actually occurring? There are actually expirations 3 days in a row. You're like, wow, that's actually crazy, right? There's a Wednesday, a Thursday, and a Friday expiration. Each of them have unique implied volatilities. The implied volatility, okay, is increasing substantially as we come to weekend. Why? There's an employment situation out here. But This actually begs the opportunity to trade on a daily strategy throughout the course of the week. Okay, here at TheoTrade, I'm going to be tinkering in the SPX, trading daily expiration. I don't think too many people have caught on to this just yet, but oh boy, it's going to be fun because these options are liquid, okay? And this is going to provide some very interesting trading opportunities. Stay tuned, much more to come here at TheoTrade. Thanks a lot, everybody, for joining me here on this Easter weekend.